Hello and welcome. Today, we are really getting into the heart of what it means to be a long-term investor. We're not just going to talk about picking a few stocks here and there. No, we're building a complete blueprint, a framework for finding the kinds of businesses that can truly compound your wealth for decades to come. This all comes right from Chapter 6 of The Infinite Investor. And it all boils down to one simple but incredibly important question.
Seriously, what makes the cut? Think about it. When you build a portfolio, you have different buckets, right? Some are for those fun, speculative bets. But that core bucket, the big one, the one that holds about half of your entire portfolio, well, that has to be filled with businesses that can do more than just survive. They have to thrive. The stakes for getting this right are just unbelievably high.
Okay, so here's our game plan for today. First, we're going to talk about why this selection problem is so critical. Then we'll get into the fun stuff, the two forces, what the author calls the twin engines, that are behind truly extraordinary returns. After that, I'll introduce you to a really cool concept called the margin of expansion. And finally, we're going to pull it all together with a powerful visual tool, the ROE-Growth Matrix, to figure out where a company really stands. Let's get into it.
All right, first up, the critical selection problem. We're zeroing in on what the book calls Bucket 3. Now, this is not the place for your flyers, your lottery tickets. This is the core. We're talking about half of your capital. And whatever goes in here has to be able to compound and endure, not just for a year or two, but for the long haul.
And this, right here, is the key. A bad choice in your speculative bucket? Okay, it stings, but it's a lesson learned. A bad choice here, in your core portfolio, is a completely different story. It's a massive anchor. It becomes dead weight that is actively holding you back, dragging down your ability to build wealth for years, maybe even decades. So the process for choosing these companies has to be incredibly tough, filtering for just one thing: businesses that can compound their intrinsic value over very, very long periods.
So, how on earth do you find those businesses? Well, first, we need to really understand the mechanics of what creates those mind-blowing returns. Thomas Phelps, who wrote the book on 100 baggers, basically figured out the core math behind creating extreme wealth.
Just let that number sink in for a second. 26% annually for 2 decades straight. I mean, it sounds almost made up, doesn't it? So how does the stock actually pull that off? Turns out it needs not one, but 2 powerful engines, both firing at the exact same time.
And here they are, the twin engines. First, the company itself just has to grow its profits, its earnings, year after year. And I'm not just talking about revenue, I mean real actual profit. That's engine number 1. But then engine number 2 kicks in. The market has to see this quality and decide it's willing to pay a higher and higher price for every single dollar of those earnings. We call that multiple expansion, which is just a fancy way of saying its price-to-earnings ratio, or PE, goes up.
And what's so critical to understand is that these engines don't just add together, they multiply. Look at this chart. If a company's earnings grow 5 times over, great, it's a 5x return. And if the market's perception of the company, that PE multiple, doubles from, say, 15 to 30, well, that's another 2x return. But put them together, you get a 10x return. This multiplication effect is everything. It's the secret sauce behind those life-changing investments.
Okay, so we know what we're looking for. We need those twin engines roaring. But the million-dollar question is, how do we find companies where both of those engines still have plenty of fuel in the tank? To do that, we have to shift our thinking a little bit, from playing defense to playing offense.
Value investors always talk about having a margin of safety, buying $1 worth of assets for 50 cents. It's a great defensive strategy that protects you when you're wrong. But for the kind of growth we're talking about, we need what the author calls a margin of expansion. This is pure offense. It's all about buying in before a company's greatness is obvious to everyone, positioning yourself to capture that big re-rating from the market when they finally catch on.
So what creates this window of opportunity? Well, it comes down to 3 things. First, the company's profitability, its return on equity, or ROE. It's good, but it's not at its peak yet. Second, the valuation, that PE multiple, isn't totally stretched. A stock trading at 40 times earnings already has all the good news priced in. But one at, say, 18 times? That has room to run. And finally, and this is so important, the business needs a long, long runway to reinvest its profits at those high rates of return.
And this brings us to the trap of obvious quality. Look, everyone on the planet knows Coca-Cola is a fantastic business. But if you're buying it at 35 times earnings when its growth is pretty mature,
you're really just buying a single-engine business. The quality is already fully recognized, it's all priced in. It's a solid stabilizer, for sure, but it's not a compounder anymore. The mistake isn't owning it. The mistake is expecting twin-engine returns from it.
Okay, to help us stay out of those traps and spot the real potential, we can use this simple but really powerful visual map. We can literally plot any company based on two key metrics: its profitability, or ROE, and its growth rate. And when we do that, we get what's called the ROE-Growth Matrix. This matrix gives us 4 distinct quadrants. Up in the top left, you've got quadrant 1, the compounder. High profitability, high growth. That's the dream spot, right? Think of Google in its early days. Then, top right, you've got quadrant 2, the cash cow. High profit, but low growth, like Coca-Cola today. Bottom right is quadrant 4, the trap, which, yeah, you want to avoid that. But the most interesting box on this whole map is the bottom left.
This is quadrant 3, the candidate. These are companies that have figured out growth, but their profitability is still low, maybe because they're pouring every dollar back into getting bigger. This is where the future 100-baggers are often hiding in plain sight before they become obvious. The opportunity here is just massive. You buy them at quadrant 3 prices, and if they can successfully make that leap into quadrant 1, you end up owning a true compounder that you got in on way early. Of course, the big if is that many never actually make that jump.
So the matrix is like a snapshot in time. It tells us where a company is sitting right now. But honestly, what's even more important is its direction of travel. We need a compass to see where a company is going, and that's where we need to look at its trajectory across the map.
And the story here is pretty stark. When you look at all the possible paths a company can take across this matrix, it turns out only 2 of them consistently create wealth for shareholders over the long term. The other 4 are traps, each one a different kind of dangerous.
Let's just quickly run through these paths. Trajectory 1, the aligned compounder, is the absolute ideal. That's a company like Costco that just stays in that top left box, its flywheel just humming along. Trajectory 2, the efficient compounder, is a solid stabilizer like Coke. But the rest? Traps. You've got the efficiency maximizer, which can only grow by cutting costs. That's a finite game. You've got the declining giant, whose moat is eroding, the revenue chaser, which grows its sales but never makes a real profit, and finally, the inefficient allocator, which just plain destroys value.
So, we have our map now, the ROE Growth Matrix, and we have our compass, those 6 trajectories. We know to look for companies that are either stable in quadrant 1, or even better, making that exciting journey from quadrant 3 to quadrant 1. But that still leaves one huge question hanging in the air. How do we actually apply practical, real-world filters to separate the true, durable compounders from all the pretenders? Well, that is exactly what we're going to cover next time.